Good afternoon, everyone, and welcome to Workforce Wednesday webinars. My name is Anissa Franklin, and I'm serving as your host today. I am the Chief Administrative Officer at the Urban League. Today, we're going to be talking about home ownership. And these days, there's a lot happening with home ownership. We've got a lot of houses that are being sold, a lot of houses that are being purchased, and we want you to know how you can get in on the action. So it is my pleasure to welcome also on our screen today, Tyler Hamilton, as well as Tina DeBoard and Sean Blades. I'm going to ask them if they would go ahead and start their video so that we can see their faces. And we're going to ask Tina if she would start just to tell us a little bit about who you are and what you do for our sponsor for today's event, which is Truist.
Well, certainly. My name is Tina DeBoard. I'm a mortgage loan officer for BB&T, now Truist Bank. I am out of the Winchester branch. I've been in the business for approximately 22 years, work a lot with first-time home buyers, veterans, and basically what I do is first mortgages.
Sounds good. We're going next with Miss Blades.
Hi, I'm Sean Blades. I'm a branch leader here with BB&T, now Truist. I manage our Beaumont Center and our Nicholasville Road locations, and I am happy to help you with this project.
All right, and then our final person is Tyler. Tyler, tell us a little bit about yourself.
All right, thank you very much, ma'am. My name is Tyler Hamilton, and I am the manager for our offices in Hamburg here in Lexington and in Winchester, Kentucky as well.
All right, well, I want to welcome all of you again to Workforce Wednesday webinars. We're really excited to have you. So we talk about home ownership today and helping people to get on the home ownership trail. So with that, feel free to go ahead and share information with us. And if anyone has any questions that you would like to ask, please go ahead and feel free to type those in on Facebook, or just let us know what your questions are and we'll make sure that we get those asked for you. So without further ado, I turn it over to Truist.
All right, guys, thank you all once again for allowing us the time to come out here and spend a little bit of time and take up some of your all's free time today. I'm going to go ahead and start sharing my screen so that we can get in here for the presentation for you all. Let's see here. That to there. All right, can everybody see my screen?
Yes, sir, we can see it.
Okay, awesome. All right, well, as I said, we appreciate you guys taking some time out and letting us share some of the information with you all today. We'll be going over our Bank on Your Success Becoming a Homeowner presentation. And so just to kind of go over here a little bit of the course overview, a couple of things we're going to really go over with you all today would be, are you ready to buy a home? Some important terms to remember, the differences in renting and buying a home and some of the benefits that come with those as well. And then we have a couple of knowledge checks and some matching games for you all as well. Then we will kind of talk through the different mortgage loans that are available to you. And then last but not least, we'll kind of figure it up with questions to ask your real estate agent whenever you're going out and to look at purchasing a home or being a part of that process. So without further ado, I will turn it over to Ms. Sean Blades.
Good afternoon. We are happy to be here today and share this information. It is a wild time in the real estate market, so anything we can do to help you realize that dream, we are excited to be a part of. Part of being a homeowner is figuring out what is the right process for you. Where do you go to get a loan? What information will you need to get pre-qualified? What types of loans are available to you? And one of the first questions is, where do I start? So you want to start at your financial institution. Go in and sit down and talk with your banker. Let us talk with you about what is the right property, the right product, what information you're going to need. You can also utilize credit unions, and they're also mortgage brokers that will kind of be intermediary. So they're kind of like a go-between lenders and the borrower. But again, always the best place to start is going to be right here with us, and you can have that conversation so we make sure that we're on the right path. When you're looking at types of loans, You're going to have a lot of different options. There are fixed rate mortgages where you pay a fixed monthly payment for a set number of years and you own that outright. Through that process, you build equity so that that home becomes your asset. There are also adjustable rate mortgages. With an adjustable rate mortgage, you're going to have an interest rate that is variable, so that can change over time, which in turn would affect your monthly payment. So your monthly payment could vary right there. So it's really important to think about what that product looks like and how would that affect you in your future. As you're looking at information that you're going to need to gather, you're going to want to gather your residence history. So to get pre-qualified for a product, which you always want to get pre-qualified, because when you're out there shopping for a home, it's a competitive market and you want to go with your pre-approval. So pre-approvals and pre-qualifications are the same thing. So you want to go there to make your offer on that home with that letter in hand. I'm serious about this property. I'm pre-qualified or pre-approved, it's the same thing. And here's what I've got. So when you come to the table, you're going to want to bring your residence history, so 2 years. You want to, your street address, if you're renting, you want your landlord's information, your employment history. You'll also want 2 years of employment history. So you'll want your last 3 pay stubs or your last 2 years tax returns. I'm sorry, give me just 1 second. Your deposit and retirement accounts, if you have checking and savings accounts, you're going to want to bring that information available. We're going to take a look at your history, your payment history. Are you paying your bills on time? What does your credit look like? And here's what's really important is you are getting geared up to that process to make sure that you are getting to a place where you don't have any late pays. Even 1 day past 30 days is going to affect that credit negatively. So what's your total monthly debts? Are all your routine financial obligations accounted for in your total debts? So that's your phone bills and your rent and your electric, those things. Those things can also negatively impact your credit as well. Do you have some money saved for a down payment? Now, there are some mortgage programs that will allow gift funds from state and local programs. So, and there's also like VA loans. So if you're a veteran, there's some options there as well. Do you have some money saved for closing costs? What is that going to cost? And that's going to be part of your pre-qualification process, is talking with your mortgage lender about how much is that going to cost, and is that out of pocket, or is that something, are there programs to assist with that? Because there are programs that can assist with that if you meet certain qualifications. One of the things is, do you have time to take care of a house? It's a lot of responsibilities. You got to mow the lawn and make repairs. So if the plumbing goes out, you're going to have to call a plumber and not your landlord. So that becomes a whole different situation. And it is a bit time consuming, but don't be afraid of that. It is, the home buying process can take a while to find the right property, the right fit, make the right offer. Do you have money to cover moving expenses? It's surprising as you start moving how those expenses could add up quickly. And if you've experienced financial difficulties in the past, can you prove it was due to events beyond your control? Did you have loss of employment or medical issues? So there are some things that can be explained away, but otherwise you're going to want to really work towards making sure that you've got that credit in a great place. So some of the questions you might ask. Oh, yes, go right ahead.
So one of the questions is, if I am in debt and I'm trying to consolidate my debt, should I do that before trying to purchase a home, or should I just go ahead and try to make those payments outright?
So Anissa, if you have the capability, so say if you have a lump sum of money, you would want to go ahead and pay those if you have that available to you. If it's something where, okay, I'm looking towards the future, in the next couple of years, I really want to buy a home, that is when you want to come in and let's talk about getting that consolidated and paying those debts down to improve your debt to income ratios. Don't wait until you're, oh, I want this house, it's available right now, I want it. You've got to think ahead. So it's really important. We're here to help. Come into the bank and talk to us. We want to help you. So it's great to look ahead, especially the last 2 years of your history is really what affects your buying power there.
All right, so another question is, do student loans hinder you from purchasing a house? Because we know sometimes those student loans can be rather large. And so just wondering how that plays into the credit history.
They can, and this is where we do see a lot of folks who get behind on those student loans. It's important to know that there are programs to help you manage those student loans and to uncover repayment opportunities. So they do matter. In short, they do matter.
Okay, and so the first or another question is, before I am ready to buy a home, like if I'm just thinking about it, is the best option for me to like come in and talk with you first to see what it is on my credit that may need to be fixed, or that I may need to address before moving forward? Like you said, don't come in when you see the house that you want to purchase, but come in earlier and just find out some information on what needs repairing, if you will.
Absolutely. There is annualcreditreport.com. We use that quite frequently when we're doing credit counseling. You can go to annualcreditreport.com and pull your full credit report. We are happy to sit down and look at that for you and identify areas that need taken care of, or if there's something on there, it's shocking the things that you might not even realize are on there that you could dispute and would be removed completely. So it's really important that you keep an eye on that.
Okay, that's all the questions that I see right now. So go ahead and continue.
Okay, very good. So some questions is your income reliable and continuous? And you want to look at least 2 years, the last 2 years. And if you're in the same field of employment, that's going to be okay too. If it's going to be a whole different job field, we may need a little more explanation there. So that's something to consider as well. You have your checking and savings established, so you want to have some money saved away. So a good rule of thumb for us is 10% of every paycheck or goes into that savings plan, especially as you're looking towards buying a home. Did you file your income tax? Sometimes if you're self-employed, folks tend to write off a lot, so it's real important to show that income. I know you don't want to pay taxes on it, but it's important that you show that income so that we know their source of repayment. Are your bills paid on time? Again, even being 1 day, that 30-day late on your credit bureau is a big deal, and that can stick out there and affect you negatively for 2 years. Are your monthly debts manageable? This is where Anissa said, come in and talk to us. Let's look at that and see if it's structured correctly, or do you have like little bills that should be consolidated to a manageable monthly payment that improves your overall debt picture. Closing costs, again, something to discuss with your mortgage lender. Tina's going to know more about that because she specializes in those products. And then looking back again to the responsibility and the upkeep and the expenses that can be there. Tyler, if you want to move forward.
Well, all right, guys. So I'm going to go ahead and click it over here to the next slide for us. So the next part, we're just going to talk a little bit more about the benefits of owning a home. Some people rent a home because they think they can't afford to buy one. Others like the flexibility that comes with renting an apartment or house. When you rent, you can have the flexibility to live in a particular place for as little or as long as you want. You're also free of most maintenance responsibilities. For example, your landlord will generally handle the repairs that would be needed to the apartment or townhome or a house if you're renting that, for instance. There are many reasons though for owning a home. Let's take a moment to go through some of the benefits you'll enjoy by owning a home. Owning a home gives you the opportunity to build equity. Let me explain this a little further. In the early years, most mortgage loans, the majority monthly payment will go towards paying the interest on the loan. As time progresses through, an increasing amount of the monthly payment goes towards reducing the mortgage loan balance itself, or the principal. This is called amortization. As you make payments, you reduce the principal and increase your share or equity in your home's value. If your home increases in value through appreciation or an increase in the market value of your home, your equity will build even faster. Why is home equity a benefit? First of all, if your home becomes free and clear of mortgage debt, you will no longer have a housing payment. And if needed, you may access your home's equity through different financing options for larger expenses. For example, Martha, a valued mortgage client, was able to use the equity in her home to help pay for her daughter's college tuition and other expenses. Now, I don't need to point out to you that there's no guarantee that your home will go up in value or that you'll make a profit when you sell your home. It all depends on current market conditions. Another great benefit of owning a home is the potential tax advantages you may enjoy. When you own a home, you may be allowed to deduct the mortgage interest and property taxes off your income taxes. These deductions may provide you with significant tax savings, especially in the early years of your mortgage. Be sure to consult your tax advisor about your specific circumstances. Monthly payment stability is also a benefit of owning a home. For a fixed rate mortgage loan, you'll make the same monthly principal and interest payment for the length or term of your loan. Homeowners insurance and real estate property taxes may increase over time. Unlike renting, this type of principal and interest payment will remain the same month after month, even when inflation leads to higher pricing. And then finally, owning a home will provide you and your family with a sense of community. When you own a home, you know your family has a place to live. When you rent, you may be able to renew a rental agreement, and you may have to find a new place to move. Once your mortgage loan is paid in full, the home is yours. You can even pass it along to your children or other relatives as inheritance. So let's just take a moment to kind of review what we've just learned there. I know it kind of went over a lot, and as you can see here on the screen, it does give us a couple of terms here, and so I just wanted to define those for everybody so that they would have a better understanding. Equity is the value in your home above the total amount of the liens against your home. For instance, if you owe $100,000 on your home, but the home is worth $130,000, you have $30,000 in equity built in. The next term we'll go over is the mortgage. So a mortgage is a signed document by a borrower when a home loan is obtained and gives the lender the right to take possession of the property if the borrower fails to make the loan payments. The next term is interest. Interest is a charge for using someone else's funds. Interest is typically indicated as a percentage of the amount borrowed. For example, you pay an interest rate on a mortgage loan. Principal. Principal is the actual amount of money borrowed or the remaining amount of money on the loan that has not yet been paid back to the lender. The principal balance of a loan is the borrower's debt. Amortization. Amortization is the gradual reduction of the outstanding balance of the loan as the amount of the loan is gradually paid down over a predetermined period of time at a specific interest rate. Appreciation. Appreciation is the increase in the market value of the home due to changing market conditions and/or home improvements. Homeowners insurance. Homeowners insurance is a policy that protects you and the lender from losses resulting in things like a flood, fire, which may damage the structure of your home and create a liability, or cause damage or theft of your personal property. And then last but not least is inflation. And inflation is an increase in the general level of prices. So I think we're kind of seeing a couple of these things, especially in the housing market and stuff that we are in right now. And then Anissa, actually what I was thinking is, since I've only got the terms up here, what I will do is I will get the definitions over to you as well so that you can share it with everybody in case they weren't able to take notes or anything on that part of it.
So Tyler, I have a couple of questions for you. One is,
Yes,
what is the difference between equity in the home and a second mortgage?
Okay, so equity itself is just what is built in. So like in the one instance there, they owed $100,000 on the mortgage. Or on the home, and that would really be what we would consider as the first mortgage. That was the mortgage that was used to buy the house, and that is what's showing out there. So if the home was valued at $30,000, they have $30,000 of equity built in. I think kind of what that sounds like with that question is what a lot of people will think of as like a home equity line of credit, which is also referred to kind of as the second mortgage. And so in a situation like that is, let's use those same numbers. Say that you owed $100 on the mortgage, but the home valued at $130,000. In some situations, you could do a second loan or a home equity line of credit in that situation to access that $30,000 in equity. That way, that could help you. I think in the one there instance that I was going over, the mom had helped the daughter pay for college tuition. So there's ways that you can access the equity that you have built into the home.
So do you have to pay that equity back?
Yes, if you take a home equity loan out, yes, you would get that $30,000 to be able to spend and purchase whatever it is you're needing at the time. But yes, you would have to pay that back over time as well. And there's different terms and financing options. Different institutions will have different terms and policies and stuff around that.
Okay, and so a related question is kind of using the same numbers that you used. If I own a home and I owe still $100,000 on it, but when I look at Zillow or someplace like that and it says, my home is valued at 250,000, does that mean that I can walk away if I sell my home, that I can take $150,000 with me to the purchase of a new home?
Yes, but what I would say is there could be a couple of situations there. So I don't know if they had already previously sold a home or anything from that standpoint. So I don't know if they would have to pay a capital gains tax or anything from that standpoint. But yes, in the thought process of that general question, yes, you would have that 150 to apply towards the next home.
Okay, sounds good. That's all the questions I see for now, so feel free to continue.
Awesome. Thank you, ma'am. So we'll just continue right in here, and this is just kind of comparing the should you rent or should you buy a home, and kind of goes over a couple of the different benefits of having that. So obviously when you rent a home, you're free of the maintenance obligations. If there is a leak in the roof or if the HVAC unit goes out, that is the landlord's problem. That is not your problem as the renter. Also, you're not committed to staying in a house or a neighborhood. So a lot of people that if they travel for jobs or if it's something to where, if they've moved different cities every 1 to 2 to 3 years, in a lot of instances like that, it's making more sense for them to rent a home because they're not having to put in as much money to purchase the home and everything from that standpoint. And based on their track history, they could be moving in another year or two. And based on the ebbs and flow of the housing market, they could take a loss if they were to actually buy the home instead of just renting, which also leads us into the next one there, can move quickly. When you're renting, you can kind of get out of those contracts. It's a little bit easier to get out of a rental contract than it is to sell a home, which might be a little bit of a bad statement right now because I know it is a seller's market. And then also just free of cost, you're not going to have to pay homeowners insurance or property taxes on the property. I would advise renter's insurance though if you are renting. As far as buying a home, it does give you that opportunity to build equity, and it does provide you with the tax advantages because you can write off the mortgage interest and the property taxes from that standpoint. The stable monthly payment, so typically on most mortgages, they are fixed in for 30 years. That payment should remain the same for the next 30 years for you. The only time you're ever going to see a difference in that is if your property taxes increase or decrease, or if your homeowner's insurance was to increase or decrease. And then the strong sense of community because you are there in the community, you've bought that home, and you're probably planning on staying there for at least 5 plus years in those situations. And then obviously always just consult your tax advisor about the tax advantages. We are not a CPA firm, we are just a bank, so just to make sure on that one. And then down here, it does give you some of the helpful hints there as far as using the additional tips to help you figure out what you can afford to spend on a home. So creating a spending plan with your estimated mortgage payment, and you can include your property taxes and your insurance in there. That way you can kind of know what it is that you can afford and know what price range that you're going to be looking for when you go out to look at purchasing the home. Include your utility costs of the future home maintenance repair costs in your spending plan. So just think about what your water bill would be, what your gas bill would be, electric bill, things like that. Sometimes just people always are just worried about, can I make that one monthly payment of affording the house, but they forget about the other things that kind of come along with that as well. Remembering your other goals, such as college and retirement. So what I always like to tell people is you don't want to be house poor. You don't want your entire paycheck going to nothing but the house. You want to have the ability to live and have other goals set for you. I don't think anybody here wants to work until the day they die. So saving for retirement or saving for your kids' colleges, that can really come into play there for you. And then just selecting a mortgage amount that allows you to meet your long-term goals and needs. So once again, goes back to don't buy too much house and put yourself in a situation to where you're going to struggle to make those monthly payments. And then last but not least, I have a knowledge check for us here. So we'll just kind of go through those really quick. Number one, everyone should buy a home. It's just a better option. Is that true or false? The answer is false. It's not just a better option for everybody. It would be more so along the lines of what makes sense for you at that point in time.
Tyler, let me interrupt you for just a second. I want to ask all of our folks who are on the panel, if you will, to show your cameras, and let's answer these together.
All right.
I know you guys know the answer.
I do have a cheat sheet, so I'm in good shape.
Right. So Tyler, go ahead and ask that first question again.
All right. So everyone should buy a home. It's just a better option. Is that true or false?
False.
There we go. We got one right already. Moving on to number 2, appreciation describes an increase in the market value of a home due to changing market conditions and or home improvements.
What do you say, Sean?
Absolutely. Absolutely.
That is correct.
The market right now is dictating wild prices here in Lexington in particular.
So I've heard, a friend of mine was trying to purchase a home and he put in a bid for the home that was $40,000 over the asking price and he was still beat out.
Yes.
Someone else purchased it. So the housing market right now is, wow.
Yeah, and from everything I'm seeing, it's like that nationwide. I mean, there's not many places that you can go to and have a lot of inventory to choose from.
Do we know why that's happening right now? I know for a while we saw, way back when, like 2008, we saw a dip in the market. So like my house value went way down. And now it's like it's skyrocketing. It's like, well, you would think at this point that nothing would be moving because we've just come through this pandemic. So just curious about that.
There's a few theories, and one of them is the pandemic itself, or folks realize they're in lockdown and they're being locked down in apartments and things, and they're like, oh, we would really like to have our own space. We want a yard. We want to be able to go outside. So one of the theories is that is driving a lot of it. Another one is that the cost of building materials is astronomical right now. So the building has slowed down. It's slowed down just a bit. So people are looking for houses that are already available.
Yeah, and that's what I was going to say. The lumber cost skyrocketing has really shied people away from actually building houses, and they're looking out there for what's currently available. And then kind of like Sean said, during the pandemic, especially like in your bigger metropolitan areas, like out in California and New York City and places like that, you had people that had money saved up that they could use, but they weren't going into the city anymore. And with the remote workplace and stuff like that, you've seen more people kind of leaving those areas and going out and buying houses in other areas now.
Sean's did.
And I will say, I'll just add this on, is there was, David O'Neill, the PBA, did a presentation last year and talked about the exponential growth that Lexington is expecting. And, they saw this coming, that there was going to be much more demand than there is supply for particularly the Lexington market.
Okay, wow.
And then the last question here on the last one would be just to help you to determine if you should buy a home, you should create a spending plan with your estimated mortgage payment. And would that be true or false?
I say yes.
The answer
I'm a planner.
is true.
I need
yes.
to see it.
Right.
Yes, ma'am, for sure. All right, and then with that, if I'm not mistaken, I'm getting ready to serve it up to the lady of the hour, Miss Tina DeBoard.
The lady of the hour, boy, you use that term loosely. And of course, I love mortgage, so I tend to love to talk about this. I love homeownership. I love helping people get into homes. And so if I get where I talk jargon, just let me know to slow down and stop, because I could talk about this all day long.
I will do that.
I mean, this is my love. I've been doing it so long. I enjoy it, and I tend to talk about it a lot. So the first thing that most people are going to talk about, and I'm not going to read off this script, I've just made a few notes. When people get to the point of being ready to buy a home, or they start exploring those options, one of the first thing they want to know is how much down payment am I going to need? And that's a good place to start. And down payments can range anywhere from 3% up to 20%, depending on what you have. The other thing is there's some programs out there, such as the VA loan, that's 100% financing. You don't have to have a down payment. There's another product that's not eligible in Fayette County, but in some of the surrounding counties, such as Jessamine, Woodford County, Scott County, parts of Clark County, and parts of Madison. It's called a rural housing loan that doesn't require a down payment. So down payment can vary depending on what loan you qualify for, depending on the area you're buying, depending on your income. The next thing that is going to be an expense and is going to play into your monthly payment is mortgage insurance. And there's two different types of mortgage insurance. Mortgage insurance is required anytime you have less than 20% down. So mortgage insurance on a conventional loan is called private mortgage insurance. When you get into something along the lines of a government loan, which would be FHA or rural housing, it has a different term, but the point of the thing is all the same. It plays into default. It doesn't protect you as a buyer or a homeowner. It is protecting the lender in case of default. So mortgage insurance, private mortgage insurance, and a VA loan is called a funding fee, and a rural housing loan is called a guarantee fee. Those are all different types of insurance that helps in case of default and covers the lender. So along with those costs, those two things, then along comes closing cost. And in a lot of cases, prior to us going crazy in this market, a lot of folks, first-time home buyers primarily, they may have the money saved for a down payment, but there's other costs that go along with doing a mortgage. And those are closing costs. And those costs can range anywhere from 3 to 7%. So in that regard, prior to this market, first-time home buyers were looking to the seller to assist with that. They might ask the seller to cover, hey, I'm going to buy this house and make a full price offer. Can you cover my closing costs and the amount of blah? That is not very common right now, and especially in this market. So when you're looking at buying a home, you got to keep that in mind, that you're not only going to need a down payment, but there's cost involved with the closing of the actual purchase and the closing of the loan.
Now, Tina, can I ask, is
You
there
sure can.
still down payment assistance programs?
There
Like
are.
VA and others that can help with that?
There are down payment assistance programs, and depending on the bank or on the financial institution, whether they participate in that program or not. I know that BB&T Truist does not participate in, say, Kentucky Housing. We did do the Federal Home Loan Bank down payment assistance, but that program is pretty well, those funds have exhausted. And that's the thing with those kinds of programs where they're offering down payment assistance. Most of the time there is an income eligibility that has to be met. There's a cap. So those are all things that lenders, when you're meeting with a mortgage lender, banker, or whatever, they're going to know those programs that are eligible, that are either offered through their bank or may not be offered through their bank, but they're out there, that they know the programs that are available in the state of Kentucky or in your area. But yes, there are down payment assistance programs that can help with that. The thing that people need to keep in mind right now is, if you got a house on the market for $100,000 and it appraises for $100,000, but the buyer is going to have to make a $105,000 offer, most down payment assistance programs are not going to cover that gap between the $100,000 appraised value and the $105,000 that you offered the seller for that property. So if you're going to offer over appraised value or asking price, which may or may not be the same, then you're going to have to cover that difference. Down payment assistance won't. Does that make sense, Anissa?
It does. Thank you.
Okay. Excuse me. So that was my other thing, was down payment assistance. You'll hear terms like prepaids or escrow account. Taxes and insurance, if you're a first-time home buyer and you're putting less than 20% down or putting less than 20% down, taxes and insurance are required to be part of your monthly payment, especially if you're a first-time home buyer. So as you start looking to buy, you're going to have 1 year of your homeowner's insurance paid in advance. And then as you're making your monthly payment, then you're going to be putting that money into a savings account to pay, an escrow account, to pay your taxes and insurance when they come due down the road. So that can equal up to a considerable amount of money. Again, it can run anywhere from 3 to 7% for closing cost and your escrow or prepaids. So those are things to keep in mind when you are looking at buying a home. And you're going to be, when you meet with a lender, they're going to provide you with estimates as close as possible to the cost, to include, you know, down payment, the closing cost, and the escrow accounts. So those are things to keep in mind and ask for them. As a buyer, that's your right to have that, to ask for that. Did we lose Tyler or me?
No, we just wanted to change up the view a little bit. So we'll ask Tyler to go ahead and share the PowerPoint once again, just so
Okay.
we're not looking completely at the PowerPoint presentation only. We want to see you, Tina.
Oh, okay. I gotcha. Well, I can go on, and that's pretty much the end of the presentation. You know, there's additional expenses with buying and with moving, relating to, I mean, just moving your home goods, changing the locks on the doors, any amount of repairs, or any, if you want to paint, there's or appliances. Some homes don't necessarily come with appliances included. Lawnmowers, if you've been living in an apartment, you've not been mowing your lawn, so you're going to have a lawnmower. So there's a lot of other things outside of just what it's going to cost you to do the mortgage on the home. So those are things you've got to. I remember when I moved from an apartment, when I first moved to Winchester, I moved from an apartment into a house, and I had to go buy a lawnmower, and I never even thought about it. I'd owned one when I lived in Eastern Kentucky, but I'd gotten long since gotten rid of that. So I had to have a lawnmower. And I know that sounds kind of silly, but for somebody that owns a home now, but for somebody that's living in an apartment, that's an added expense that you're going to have. So we're going to cover some with the matching game. I know that don't know that your folks have the law. There's typically a handout, but we'll just kind of go through this a little bit and talk about the individual terms as to what they are. So the first definition is a failure to meet a payment or fulfill a credit obligation. That term is called default, and that's something that nobody wants to ever have to see happen to anybody, is to not be able to make your payment, or, you know, and end up with your home being in default. The second, the cost of the insurance, in which a federal home loan FHA, Home Loan Administration, provides to a lender and is paid by the individual buyer. And I touched on that briefly earlier, and that's mortgage insurance, also known as MIP. And that's, again, protects the lender, Federal Home Loan Administration, should you default on your house. And then we talked about the holding of money or documents by a neutral third party. That's called escrow. You'll hear that in two different terms. Escrow would be the title company holds the money that you may have given as a earnest money deposit, or the in Kentucky, it's not necessarily held by the title company or an attorney, but it's held by the real estate company, the real estate broker. And also escrow is a term that's used for holding of that money that you pay in monthly for your taxes and insurance to be paid down the road as they come due. So escrow has two different definitions within a mortgage, within the mortgage process. So just to kind of keep that in mind. And like I said, I try to, anytime you're working with a lender, we tend to get very involved in it, and we assume things. So if you don't understand what's being said to you, stop that lender and ask questions. And that's a disclaimer I tell people up front when I'm meeting with them, is if I'm talking stuff that you don't understand, stop me and ask the question. The next question is the legal process, or next definition. The the legal process in which collateral property is sold in an attempt to satisfy the outstanding debt of a mortgage. That is foreclosure. Again, that's something that no one wants to see. You default first, and then the lender has to start proceedings such as foreclosure to get the property back in their name so that they can sell it and get some of their money back on the property. And nobody wants to see that happen. The next definition is cost to complete the real estate transaction. These costs are in addition to the price of the home and are paid at closing. They include points, taxes, title insurance, financing costs, items that must be prepaid or escrowed, or other costs. And that goes back to that's closing cost. The next one talks about an estimate of how much money a lender is willing to loan to you to purchase a home. A full mortgage loan application is taken without any property identified. Some lenders interchange pre-approval and pre-qualification. In my previous lifetime, pre-qualification meant you didn't have a credit report pulled. And with us, it does. With Trust, it does pre-approval, pre-qualification. Pre-approval means you have provided documents and credit pulled, and the lender has reviewed your credit and there's a commitment to lend to you. Pre-qualification says lenders looked at the credit report. We may have not seen all of your other documents, but based on the information you have provided us, then you're pre-qualified. The two different things is important, because pre-qualification, should you provide documentation and the underwriter reviews that, the lender reviews that, and there's something comes up that could pose another question that may not permit you to be pre-approved. So it's really, in my opinion, really important to get in, talk to somebody, find out what's going on your credit, where your income's at. Folks that are self-employed realize that you've got to have been self-employed for a significant amount of time. 2 years is a good rule of thumb. Some cases can be less, but when Sean was talking about 2 years employment history, that applies whether you're self-employed or you're employed and working at a factory or at the hospital or whatever. So 2 years is really is a key number to remember on pretty much everything. And then the next question would be the preliminary estimate on how you can afford, on how much you can afford to spend. A full mortgage application is not taken. And again, that goes back to the interchangeable pre-approval, pre-qualification. The next one is a one-time charge by lender to lower the interest rate of a loan. This is something to keep in mind. This is points. Most people think that if I pay a full point, that you're buying the interest rate down by 1 point, and that's not the case. That is 1% of the loan amount that should reduce the interest rate, but it's not a full point reduction. Kind of a rule of thumb, it can be 0.25% change in interest rate, but it's not a full 1% change, but it is 1% of the loan amount when you hear the term points. Lender is the term used for the person or entity providing credit or a loan to a borrower at a specific term and condition. The term lender can generally be used interchangeable with the term creditor. And so that's the term lender. And then I touched briefly on a loan estimate. It is really important that you take a look at the charges that are on there, that you know what you are, what it's going to cost. Lenders have a responsibility to provide as close an estimate to the cost of doing your mortgage as possible. It gets even more detailed when you're looking at a pre-approval or pre-qualification. Those are estimates, and you're going to have those are going to be estimated right up until you get the appraisal back, you get the fees from the title company, the closing agent, those things, and those typically are done within 10 to 15 days prior to closing. You have the opportunity as a buyer to shop for your homeowner's insurance, and the lender don't know if you've got a bunch of FERS and whatnot, and that's going to impact your homeowner's policy. So we do our best to provide a really close estimate, but those things can be different based on your personal items that you have in your home. The last one on here is type of insurance that helps to protect the lender from losses in an event a homeowner defaults on his mortgage. Whoa, no, I'm sorry, that's not the last one. The next to the last one. This is something I think we want to talk about a little bit. Insurance that protects the lender and homeowner against the loss of their interest in the property because of legal problems with the title. I cannot stress enough how important it is to have a clear title, have title search done on your home. Don't just buy based on some good old boy saying, oh, I own this property, because he may or may not. So it's extremely important to have a title search done, and that's one of the costs that the lender will include in the estimate is a title search. Title insurance, which is what that is. Title insurance is a protection against, any issue relating to that. The policy will provide for legal advice, legal assistance to clear those up if they can be cleared up. We've seen a lot of folks are seeing a lot of title companies pop up suddenly, and they may or may not do a great job. A lot of times it can happen with a foreclosure, be things that are missed. And so title insurance, lenders' title insurance is required by the lender. All title insurance is important done in this business than I ever saw. The first 10 years I didn't see it. The last 13 years of my career, it's there, and people are buying it because of, there was so many companies that may or may not still be around, that did title searches and missed things. So it's not malicious in most cases by any stretch of the imagination, but it can cause major issues for you down the road. And then the last term, we talked about this a little bit earlier, a type of insurance that helps to protect the lender, and that is mortgage insurance, private mortgage insurance. And there's two different types of that. It can be borrower paid, or it can be lender paid. A lot of folks will do lender paid because it can keep the monthly payment down a little bit. But a lender should discuss those options with you once they get into your specific transaction, whether borrower paid mortgage insurance or lender paid mortgage insurance is the best option for you. I have a client that won't do anything but lender paid mortgage insurance, and has for numerous years, and most people don't understand that why his interest rate's higher, but his interest rate is a little bit higher because he doesn't have mortgage insurance. So does anybody have any questions about any of that information? That's a lot.
I do have two questions.
Certainly.
The first is regarding credit history. It says if I have bad credit with a lender, do I have to wait 7 years before I'm eligible to buy a home?
No, there's FHA. I mean, if they had bad credit with a lender, did they have bad credit, meaning a foreclosure or a deed in lieu or something of that nature? I'm going to assume worst case. Mortgage, a foreclosure with FHA is 2 years. You can buy a house after the home is sold and been transferred out of your name within 2 years, and you've reestablished credit. Conventionally, it's 5 years, 4 to 5 years, and that can vary. Some lenders have overlays that makes it longer than that. So you have to really should get in to see somebody and talk about your situation.
Okay, and two other questions. One is,
Sure.
they thought closing costs was similar to when you purchase a car, that the closing costs are basically rolled into the loan, and that is not the case with buying a home.
It is not.
Okay.
No, it is not. Several years ago, back before we had the big crash, excuse me, rural housing will permit you to roll closing costs in if the house appraises for a sufficient amount to do so. For instance, if you give $100,000 for a house and it appraises for 103, then you can finance up to 103% to cover those costs. Don't see that very much anymore, of course, in this environment. And you know, most appraisers are not going to stick their neck out. They're just not going. They're not going to go way above what's being asked of the property. And the appraiser does get a copy of the contract. So yes.
Okay, you're breaking up just a little bit. So we want to take the next 4 minutes or 3 minutes now to finalize today's presentation, but I'm hoping that we can share this presentation with those who have registered for the webinar. Is that possible?
I'm waiting for Tyler, but I don't see why it wouldn't be.
Okay, well, we'll move on that as we go forward. And then
Sorry,
someone just asked
can
if you could clarify the 1 percentage point that you were talking about previously.
It's called discount points. 1 discount point does not equal to 1% buy down in the rate.
Okay, and thank you very much for that.
And then
Can I get
Anissa,
everyone
this
to
is
come
Tyler.
on screen once again? Go ahead, Tyler.
Yeah, so I will send over the entire PowerPoint presentation to you, and I will send over the answers to the questions and stuff as well, so we will have that.
Oh, perfect. That sounds fantastic.
Yeah,
So,
I double muted myself.
Are there any final remarks that you guys would like to make?
The one thing I would say is just, once again, thank you all for allowing us to spend some time with you today. I know we covered a lot of information, and I know some of that is at a high level, and some of that it can get a little confusing. What I would also say, Anissa, is I will send over the contact information for Tina, Sean, and myself as well. That way, if people have questions, that'll have our phone numbers and our email addresses with them, so that they can reach out if they have more specific questions to maybe their personal lives.
Sounds really good.
And Tyler, can you also include the link to the financial foundations?
Yes, I will send that over as well. Yeah, and that's a good call, Sean. And Anissa, what that is it's just it's called our Financial Foundations Program. It has some modules out there that folks can go out, and it's usually short, like 3 to 5 minute modules that will help to educate them on just certain banking terms and certain things we're doing. And not only can they use that for them personally, but we see a lot of people put their kids into that. That way that the kids kind of have a little bit of an education piece as well there.
Perfect. I love that.
Yeah, I mean, I think a lot of times folks don't be intimidated. You got to start somewhere, and that's what we're here for, is ask questions. Call us, ask questions. I mean, you don't know until you ask. The answer is always no until you ask.
All right. Well, I do want to thank all of you all for participating in today's webinar. I'm sure that a lot of people who have watched with all the questions are better off for having sat in on today's presentation. I think sometimes it's less intimidating to do it virtually because you can't see like, oh no, I don't know the answer, right? So we're just trying to get the information out the best way that we can. So again, I want to thank you all for participating in the webinar today. A strong thank you to Truist for supporting not only this webinar series, but also our other programs, which I want to share with you now. Let me get there. So upcoming for the Urban League, we have a fiber optics training that is being brought to you by James McFarland, who is our Technology Center Director. So he'll be doing fiber optics and cabling in a couple of weeks, June 15th through the 29th, from 6 until 8:30 p.m. And then in July, he's also going to be doing a Microsoft Word training, and that's July 12th through the 29th. The good thing about the fiber optics training and Word, so first with fiber optics, he's done that training for a number of years now, and we've got a partner with Metronet. So what happens is after you've completed our training, and we help you to create a resume, and then moving from that, we send that on over to Metronet, where chances are you will have an interview. And we've had some people hired by them, and they typically start out at $17 an hour. Now, we also know that Microsoft Word is one of those programs that is used often in business. So if you're interested in a receptionist kind of job or just working in an office somewhere, this is great training for individuals to partake in as well. We've got the QR code there at the bottom. If you're unfamiliar with QR codes, go ahead and use the website link down below. It is www.ultech2021.eventbrite.com. Other than these trainings, we've got another webinar series coming up, or 3 more that we've got scheduled thus far. On June 16th, we'll meet with Metronet and talk about the different positions that they have available. And again, coming through our training prepares you for interviewing and knowing some of the basic foundational skills that they are looking for employment there. And then we have on July 7th, knowing how your social media is impacting your opportunities for finding employment. And then we'll have another hiring event with Kentucky American Water. We found out since that Kentucky American Water is one of those places that not a lot of people think about working, but for the people that are there, they stay for years because they enjoy the work environment. And we know that water is something that we will forever need in order to survive. So those are some of the upcoming trainings that we have, and we hope that everyone will log into those or check those out. All of the registrations are the www.ultech2021.eventbrite.com. And so with that, I want to thank everyone who participated in today's webinar, and we will see you next time.